You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
This is the Options Industry Council's Wide World of Options. Before we start today's show, listeners should know that options involve risk and are not suitable for all investors. Individuals should not enter into an options transaction until they have read and understood the disclosure document, characteristics and risks of standardized options, available by visiting the OCC.com or by contacting your broker, any exchange on which options are traded, or the Options Clearing Corporation at 125 South Franklin Street, number 1200, Chicago, Illinois, 60606. The Options Industry Council is an industry resource provided by the Options Clearing Corporation, collectively OCC. Any strategies discussed are strictly for illustrative and educational purposes only and are not to be construed as an endorsement or solicitation to buy or sell securities. Commissions, fees, margins, interest, and taxes have not been included in any of the examples used in this show. These costs impact the outcome of all stock and options transactions. Consult your tax advisor about any potential consequences. OIC was created in 1992 to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options, and the Wide World of Options radio show is one of several resources investors can utilize to learn more about options. Other resources OIC offers include webinars, articles, and self-guided options-related coursework. For more information, check out www.optionseducation.org. Now, here's your host, Mark Benzaquen.
Hello, everyone, and welcome to OIC's Wide World of Options. I'm your host, Mark Benzaquen. For October, OIC has a pair of webinars lined up to shed some light on two topics that have entered into the investing zeitgeist as of late, those being zero DTE and the rise of volume for ETFs and indices. And to help shed that light, I'm very excited to welcome Mr. Dan Passarelli of Market Taker Mentoring. Dan, welcome, and thanks for joining us today.
Hey, thanks, Mark. Great to be here.
Dan, do me a favor. Let's go ahead and get started. Why don't you take a moment and tell us a little bit about yourself, about Market Taker Mentoring, and your involvement and experience in options.
Sure. So I'm Dan Passarelli. I started down on the trading floor, well, kind of a long time ago, as a runner, and which is basically the most entry-level position you can get. And worked my way up to becoming a trader, became one of the biggest traders in my pit at the height of my trading career on the Chicago Board Options Exchange. And then since leaving the trading floor, I've sort of dedicated my life to kind of giving back to the community and helping other traders reach their goals. So I started Market Taker Mentoring in 2008, and we've trained traders in over 50 countries, trained tens of thousands of traders. I don't know. I kind of lost count.
Excellent. And education is so important, especially for today's class of trader that is certainly a different class than when you and I were in the business, when you and I were getting started in the business, I should say. So when it comes to that education, as I had mentioned in the introduction, one of the buzz topics is, you're very familiar with, is 0 days to expiration, commonly known as zero DTE. So let's go ahead and get started with the giant elephant in the room, right? Namely how zero DTE is technically a misnomer. So let's get started. Tell us why you think that is.
Yeah, so what zero DTE is there's 0 days till expiration. The option expires today. Well, I mean, if you think about it, it's always been the case. It's just that it used to be once a month. When expiration date came along, there's 0 DT for that name. But then, of course, we went to weeklies and, sub-weeklies and all that. And now it's a little bit, more ubiquitous.
Right. So the 0 DTE technically has been in existence as long as options have been in existence. It really is just trading options on the day they expire. And as you had mentioned before, when we just had monthly contracts or quarterlies or end of the month, when there were just a few expiration cycles, that day of expiration was known as 0 DTE. Now, with the proliferation of weeklies and in some cases daily expirations, the concept of trading on that day of expiration has definitely grown in terms of popularity. I've got some statistics that were curated by Henry Schwartz of the CBOE. So, for example, with stocks, and this may not be actually 0 DTE, but these are more short-term options versus long. So with stocks, for example, contracts expiring less than a week to go, average daily volume of about 24.5 million contracts per day versus contracts expiring more than a week out is about 21.5 million. So the shorter term, less than a week, at least 10% greater average daily volume than the longer term. With ETFs, it's even more of a disparity. ETFs, less than a week to go, about 12 million average daily volume versus 6 million more than a week. And then indices, 2.5 million less than a week, 1.6 million more. So it's showing that more people are trading these shorter term expiries, whether they be shorter term weeklies or specifically 0 DTEs. Also by Henry Schwartz in 2016, 0 DTEs accounted for about 5% of the total volume versus in 2024, it's over 20%. Less than a week to trade, about 46% of the total volume versus more than 30 days, it's about 74% of the total volume. And I know that these numbers are confusing, but what they mean is more people not only are getting attracted to the options product, as we know by the increases in volume, but more people are getting attracted to these shorter term expiries. Now, my question to you, Dan, is how does that affect, for example, a retail trader? Right now, when we've got a contract that we enter into today that is expiring today, at the end of the day, it's either going to be worth something or it's going to be worth nothing. So what, in your opinion, what do you think traders need to look out for? Let's look at theta, for example, time decay. It's certainly going to affect a 0 DTE contract much differently than, let's say, a 30-day. So as a retail trader, what do you think they might want to look out for? What should they keep in their mind when trading these?
Yeah, I mean, as far as what to look out for, some of the dangers, if we're going long options, just buying calls or buying puts, which is one of the most common things that 0 DT traders trade, the theta is 100%. And in a lot of ways, I actually feel that's kind of liberating. I mean, I'm the guy who loves to talk about the Greeks. That was my first book was on the Greeks. They're such important instruments. But when it comes to 0 DT trading, the Greeks become very different. And just looking at theta per se, when we think about options, I always think, okay, we look at the Greeks or we look at a P&L chart. The P&L chart just becomes so much more important. If I buy this call, is it going to move enough to cover theta by the end of the day? I don't know. In some ways, I think that some of the things that you have to look out for are they make trading a little easier when it comes to 0 DTs.
A little easier. Okay, that's interesting. That's an interesting take. So we're looking at it from the buyer's perspective, and a great point that you made. If you're buying an option for X, you've got to make sure that that option gains enough in value to where it's profitable at the end of the day, because theta is going to decay, as you had mentioned, 100%. If that option is out of the money and its premium is entirely represented by time value, come 3 o'clock or 3:15 Central Time for us Chicagoans, that option is going to be worth zero. Unless that stock moves enough, unless that index moves enough to account for that erosion of theta. From the seller standpoint, that's got to be the good thing, though, right? So do you think zero DTE is more attractive to sellers as to buyers?
Well, Mark, that's always the tricky thing with options, isn't it? whenever you get a benefit, you also get the opposite side of that.
Right.
So, yeah, I mean, when selling options, definitely, it's great to have that theta because all the time premium gets sucked out. By the end of the day, it becomes zero. But the other side of theta is gamma, which is almost kind of a weird thing to talk about with zero DTE options. It's relevant, but gamma kind of becomes infinite. Want me to explain that?
Expound, please.
Explain what I'm thinking here. So, if you think about it, what does gamma measure? When it comes down to it, delta and gamma just measure the kind of the likelihood of the option expiring in the money. I mean, that's not necessarily mathematically correct, but it's kind of conceptually correct. And gamma just sort of changes the delta. But here's the deal. When it comes to zero DTE options, at the end of the day, the delta is 0 or 100.
Right.
So the gamma is ultimately infinite or non-existent. You can kind of look at it whichever way you want. Gamma kind of doesn't matter, and delta is the actual mathematical value of delta becomes so much less important on expiration day, because at the end of the day, it's 0 or 100. It doesn't matter if it says 43 on the screen right now. We know it's going to be one of those two things.
Right. So gamma, you think, is depending on the how the investor looks at it, may or may not be something to concern themselves with, because as you had mentioned, at the end of the day, that option's either worth something, it's got 100 deltas, or it's not worth anything and it's got 0. But I've got to imagine that due to the sensitivity of the option to the stock price or the underlying index price, any changes in implied volatility has got to, really make the investor's head spin, right? If, the market goes up, a tick or two, now the option's in the money and it's worth something. If it goes down a tick or two, it's out of the money and it's worthless. Any changes in implied volatility have got to be significant, no?
I would say yes and no.
Yes and no. Okay.
Because, when it comes down to it, on expiration day, zero DTE day, traders are trading, they're buying or selling these options for, if it's directional, just to make some directional profit. If it's credit spread, to, bring in some theta, a lot of theta. But the buying and selling pressure is what causes implied volatility to change from a classic sense. But at the end of the day, because there's no time premium left, that implied volatility only affects the time premium. And so if a trader is willing to pay a nickel more on said options, and the unit of Vega is 0.001, well, okay, sure, the screen says implied volatility just rose 20 points.
Right.
But did it?
Yeah, I get that. Okay. All right, interesting. Let's say I put on a position 6 months ago and now it's expiring today. I'm trading out of that position by rolling it another month down the road. So today, there's that options volume that I did, right? I did a zero DTE trade. but I'm not getting in and out of the position today. What I'm simply doing is managing my position today and moving it further down the road. What do you have any insight on that in terms of position management and how that accounts for volume in zero DTE or the interest in zero DTE?
Yeah, we do a lot of work with zero DTE. So I'm always nerding out about the statistics and that kind of stuff. But if you look at like debit spreads, the statistics show that most of the debit spreads that trade are people closing credit spreads. They're ultimate closing positions. There are more debit spreads that are closing positions than opening. But when it comes to credit spreads, the other side of that, what we tend to see is people putting on credit spreads at the beginning of the day and just letting them go through expiration.
Mm-hmm. So you have no overnight risk, but I do want to clarify something that I like to bring up time and time again, is that when it comes to spread trading, whether it's a debit or credit spread, just because the position expires out of the money doesn't mean that your risk is gone. So you may not have that overnight risk, but you do have that aftermarket risk, specifically if we're talking about, single stocks, for example. So just something to consider. Now, I want to shift gears. Let's talk a little bit more about ETFs and indices. For those people that are new to options, how would you describe, or what would you say is the primary differences between single stock options and ETFs or indices?
Yeah, I was kind of thinking about this earlier. The obvious difference stems from the fact that an ETF or an index is a basket of securities. Mm-hmm. And when we look at the math behind baskets of securities, what becomes interesting is that the risk, I should say, let's use a better word, the volatility becomes smaller.
Maybe less sensitive.
Yeah, less sensitive. Right. Because, one security, like it has specific company news specific to that company, whereas it gets smoothed out with the basket. So there's one thing.
Mm-hmm. And then obviously the underlying, if you buy a single stock option in, XYZ, as you had mentioned, any news relating to XYZ is going to impact that option significantly. If it's an ETF that has XYZ in its basket, or if it's an indice or an index that has XYZ, as you had mentioned, it's going to be, smoothed out a little bit more. Other differences, most indices are cash settled, rather than physically with shares. A lot of them are European exercise, so you can only exercise that contract on the day of expiration versus American style, which they can be exercised at any time. But let's kind of build on what we were talking earlier with zero DTE and some different data points. Average daily volume in 2024 versus prior years. And this is something that I just saw, and I thought it was really fascinating. Indices, for example, year over year growth last year versus this year, about 7.5%. Nearly 18% growth over the last 5 years. So the last 5 years, almost 20% growth in indices, 13% growth over the last 5 years for ETFs. And then speaking of ETFs, since 2020, I see that listings of new ETFs have gone up by over 100%, 112%. One of the things I find interesting about ETFs, and this is something that that somebody pointed out to me recently, is that there are people that can trade ETFs. Let's say you don't have your approval to trade options, right? For those listening, if you do want to trade options, you need to be approved for an options trading account. Now, that's going to be different from a normal stock trading account. So if you don't have options approval, there are certain ETFs that almost behave, and Dan, I want your opinion on this, that almost behave similar to an option. right? There are there's leveraged ETFs now, inverse ETFs. So, what's your insight on that?
Well, Mark, I always found inverse ETFs to be just kind of ridiculous. Like, learn about puts.
Right. I love it.
What do you need that for? Or you could even just short the darn thing. But, puts protect you. They give you limited risk instead of unlimited risk.
Mm-hmm.
So, yeah.
Okay. I like that. Definitely more people are getting involved with those. And we will be talking more about ETFs and indices as well as zero DTE in our upcoming OIC webinar. So listeners, I invite you to tune in for that. In the meantime, Dan, I really appreciate you taking the time to sit with us. Thank you so much.
Yeah, thanks for having me, Mark. I appreciate it. Great to be here.
Yeah, it's always great to see you. Thank you. And ladies and gentlemen, that's going to do it for today's episode of Wide World of Options. Again, special thanks to our friend Dan Passarelli, Market Taker Mentoring. Again, Dan, thanks for taking the time to sit with us, providing your insight into zero DTE and ETFs and indices. Ladies and gentlemen, we'll be back next time with a whole new show featuring more industry names, market concepts, and of course, trusted options education. In the meantime, be sure to visit the events section of our optionseducation.org website. Register for our upcoming webinar events. As I had mentioned, October is going to be zero DTE and ETF, so make sure you register for those two episodes starring Matt Cashman, one of our favorite educators here at OIC. Thanks again to all of our listeners and supporters out there. And as always, please feel free to send us your questions via email at options@theocc.com or live chat with us on our website. Take care, everyone, and we'll be talking with you again very soon.
You've been listening to the Options Industry Council's Wide World of Options. If you have questions about anything you've heard on today's show, email options@theocc.com or visit www.optionseducation.org and chat with OIC's Investor Education team. Interested in connecting with OIC on social media? Subscribe to the OIC YouTube channel, like them on Facebook, follow them on Twitter at options.edu, and follow their page on LinkedIn. Thanks for listening, and be sure to tune in to the next episode of Wide World of Options.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.